Welcome back to Real Estate Mindset. Today's video is gonna be absolutely bonkers. Now, the data is in, and Zillow, you guys, Zillow has recently released its shocking new predictions for 2023. And in today's video, guys, we're gonna go over each one of those predictions. And I wanna hear back from you guys on whether or not you agree or disagree with what Zillow is forecasting. Essentially, we're gonna go over 5 different areas of forecasting about what's going to happen in the housing market in 2023. Again, you guys, according to the geniuses at Zillow. And I really want you guys to pay attention to what they're saying, guys, because I want to make sure that I'm not just crazy. And if you guys can, remember, I'm not a financial advisor. And if you can do me a favor, guys, like this video, subscribe if you haven't already, shoot me a comment below and share this, guys. I don't know what's going on with my channel. Something's up with my channel. I don't know what's going on with it. So please, guys, do me a favor, share it, like it. Let's get the message out there. Either way, guys, let's start the video now. Okay, so the name of the Zillow article is obviously Zillow's bold predictions for 2023. Midwestern markets will heat up and more friends and family members will pool their money to buy homes together in 2023 as people look for new ways to overcome the housing affordability crisis. However, that crisis will stabilize, if not improve, from its pandemic era apex. New construction will be forced on rental units, and we should see a jump in homeowners becoming first-time landlords. Those are among a slew of new predictions the Zillow Economic Research Team has made for 2023. So you guys, as we go along through all 5 of these predictions, remember, I want to know what you believe as far as do you agree or do you disagree, and I'll share obviously my opinion at the end of each of those points. But most importantly, like I said, guys, I want to know if you guys agree with Zillow or not. All right, so let's get started on their bold forecasting right now. All right, let's read their number 1 forecast. The Midwest to future front and center in 2023. While in the grip of the pandemic, the Sun Belt had a strong pull of American movers, easily meeting last year's forecast for an aggressive rise to housing market temps in 2022. Florida markets dominated the annual appreciation leaderboard in 2022, with Tennessee, the Carolinas, and Texas metro areas peppering into the top spots among the 100 largest metros. The heat will stay on in the Sunshine State, to be sure, but as affordability has become the key driver of both supply and demand in the market, places that still feature reasonable prices are already seeing momentum shift their way and should have the healthiest housing markets in 2023. Enter the Midwest. Unlike nearly every other region in the United States, prices in most Midwest metro areas haven't run up to the extremes. Mortgage costs as the share of income are still within healthy sub 30% levels across Ohio, Pennsylvania, Kansas, upstate New York, Iowa, and smaller metros in Illinois, which will allow first-time buyers to take the plunge. Lower rents and home prices in these areas make it easier to save up for a down payment. Having available houses to choose from is another key component of a healthy market, and the Midwest stands out. Inventory isn't in a massive hole compared to pre-pandemic times, and declines in new listings are smaller than the national average, encouraged by the more consistent demand from buyers. Okay, guys, so tell me if you agree or disagree that the Midwest is going to remain hot in 2023. And essentially they're saying because it's a little bit more affordable there and they have an abundance. Maybe they didn't use the word abundance, but they have ample inventory. Now, do me a favor, comment below. I think as far as number 1, I disagree with number 1. In fact, I'm kind of surprised that they would say that because we know that we do need more inventory. And if these places in the Midwest have an abundance of inventory, what that demonstrates to me is it's actually going to lower the prices for houses. The more inventory, the longer it's going to sit, the more options buyers have, the longer that inventory sits, the more likely they're going to have price cuts. So again, I disagree with what Zillow is saying here. I think the Midwest is going to decline like the rest of the nation, and certain metro areas that have the most inventory right now, I think are actually going to decline the most, just like Austin, Texas. Okay, guys, here's forecast number 2. Buying with friends and family will gain momentum. Soaring housing costs were a popular party conversation topic in 2022, but plots of buying a home with a friend or non-partner relative turned out to be more than idle chatter for a surprising share of folks. With housing costs rising far beyond previous affordability norms, those chasing down home ownership are turning to unconventional means of making it pencil out financially, and this should continue in 2023. A Zillow survey fielded this spring found that among successful recent homebuyers, 18% had purchased along with a friend or relative who wasn't their spouse or partner, and 19% of prospective homebuyers intended to buy with a friend or relative in the next 12 months. For both groups, affordability and qualifying for a mortgage were cited as the top reasons for buying together. Challenges that are now even more acute. Mortgage payments for a typical U.S. home rose from needing 28% of median household income in January to 30% in March to 37% in October, far beyond the 30% threshold where housing becomes a financial burden. But you guys, do me a favor, let me know below if you agree or disagree. Do you think more home buyers are going to lean on non-spouses or family members to help them get into homes in 2023? Now, personally, I do agree. The one thing, right? Well, so far, one thing I agree with Zillow. I believe that is going to spike. And the thing is that's always been going on. It's called in financing. If someone's essentially co-signing with a mortgage holder, it's known as a non-occupying co-borrower or non-occupying borrower. So, different loans, different rules. But yeah, I actually think that is going to increase because, yeah, things are extremely unaffordable and it actually gives a leg up to first-time home buyers. So, if they have a family member co-sign, maybe they can get a good deal. But the reality is if families do co-sign, they're at risk, right? You're at big risk if whoever the mortgage holder is, if they're late on the payment, that is going to negatively affect the cosigner. So although I don't necessarily think it's a good thing for the cosigner to do that, I do agree with them that it will surge in 2023. Prediction number 3, affordability crisis will stabilize, if not improve. That was a hard one for me to read. Affordability, the share of median income required to pay housing costs, is the biggest challenge for buyers, sellers, and renters today. Monthly mortgage costs have doubled since 2019, driven by pandemic-era price hikes, and to an even greater degree by rapid mortgage rate growth this year. Higher mortgage rates are not only pushing buyers to the sidelines, they're tanking new inventory as homeowners decide to hang on to their current houses and low rates. Renters are not exempt from the madness. Rents have grown faster than wages, making it harder to save up for a down payment. The average hourly wage has grown 23% over the past 5 years, but rents are up 37% during that same time after a pandemic-era surge. Affordability will continue to be the driving force in the housing market in 2023, but there is a decent chance it will actually improve. At the very least, the market should stabilize, making it possible for households to budget and plan for housing decisions coming up in the months and years ahead. Zillow expects national home values to remain relatively flat next year and even fall in the most affordability-challenged markets. Mortgage rates highly impact the mortgage payment, and seeing some recent and encouraging progress downwards as the inflation and labor market tightness show small signs of ease, enough to lead some to suggest the Federal Reserve may ease its aggressive monetary contraction. If we've actually turned the corner on inflation, that should continue. Volatility in mortgage rates could continue through early 2023. However, an ongoing challenge for those who saw their ability to qualify for the same mortgage change on a monthly or even weekly basis this summer. Rent growth should hear closer to historic norms next year as well. Annual growth has come down quickly from a massive peak of 17.1% in February to 9.6% year over year by October. Rents actually fell during the month of October for the first time in 2 years, a signal of return to regular seasonal patterns. Meanwhile, builders are working to increase the supply of rental properties at record pace. So, do you agree or do you disagree? Do you guys think that 2023 things are going to become more affordable? Personally, I disagree. I don't even know how they're saying that, right? The Federal Reserve hasn't even pivoted yet. The thing is, guys, going into 2023, what's going to be more expensive? Well, first of all, school loans haven't even started yet, but also property taxes. America is in store for another surge in property taxes, making things much more affordable. Not to mention, America's broke right now. The savings rate percentage is in the low 2% right now. Not only that, people are drowning in debt. So I don't get how Zillow is saying the affordability crisis is going to stabilize. I think it's going to pick up because remember, we don't even have the surge of foreclosures yet, or even bankruptcies. If we're going to have a surge of foreclosures, bankruptcies, or short sales, things are going to get more unaffordable. So I disagree sharply on what Zillow is saying. I think it's complete nonsense. Let me know whether or not with number 3 projection, do you agree or disagree? Prediction number 4, surge in first-time landlords in 2023. The record low mortgage rates of 2020 and 2021 spurred lots of investment in second houses, especially from mom and pop investors getting their second property. As rent growth continues its aggressive pace, but it's not, it just said it's not. Many of these second homes have an even better potential to yield regular rental income above mortgage payment fixed with record low rates. The potential for regular income bearish expectations for stock markets in 2023 and the big pullback from home buyers due to higher mortgage rates may reinforce the incentive to hold on to these investment properties, especially in areas like Midwest Sun Belt, where household formation and housing demand is stronger. Rents should rise faster than home values over the next year, and many will choose to rent out their property. So you guys, do you agree or do you disagree that going into 2023, we're going to have more first-time landlords than we've had ever? Now, the thing is, guys, I disagree because I believe the last 2 years, we've had more landlords than we've ever had in history. So now that we're going into a declining, crippled housing market where the cap rates are actually destroyed, why would people become more landlords? So I think what this is saying is pertaining to second houses, like in Florida. So they're saying a lot of those second houses are going to be turned into rentals. But here's the thing, you guys, if we have a rental market crisis in 2023, they're not going to be able to rent those houses out. So either they'll rent those houses out or they're going to sell those houses for under market value to get rid of them, or they're just going to continue to hold. But again, you guys, I disagree with forecast and prediction number 4. Now, bold prediction number 5, new construction strength will be in rentals. Despite a clear effort to pull back on permits and starts in single-family construction, the sheer number of units currently under construction after the pandemic construction boom will mean continued rolling deliveries to the market even as demand pulls back. That is key. This expected temporary glut in new homes available are driving price reductions for new constructions and potentially in the existing home market too, where otherwise we'll continue to experience low inventory levels as existing homeowners hold on to their homes and their record low mortgage rates. To mitigate the bloat in builders' portfolios of finished homes, builders will encourage buyers with lower prices but more impactful to the affordability on the mortgage payment to offer to buy points and lower the mortgage rate of new construction buyers. The reality is with these buy downs, you guys, they're not actually buy downs. Did y'all know that? They're not buying down the rate. Essentially, they're just putting money in an escrow account to help you with your mortgage payment. It's not a buy down. They're just putting money aside in an escrow to help you with your mortgage payment. It's not a buy down. Builders of multifamily units are in contrast, much more bullish. The number of multifamily units to start construction each month has fairly steadily increased, reaching 8% from the pre-pandemic in October. Elevated multiple family permits also point to a strong vote of confidence in continued demand for rental units despite looming recession fears. This coincidence will also encourage more construction for build-to-rent homes, as many would-be homeowners will need to continue renting until later life stages if now unable to qualify and move forward with the purchase of their own. So this one is a hard one for me, guys. I can tell you that initially I agree with Zillow here. I think a lot of these new builders are going to package up their communities and sell them to institutional investors for a bulk discount. Institutional investors will turn those into rental communities. Here's the thing though. Here's why this may not happen. Number one, inventory. The supply and demand rule. I mean, there's so much supply for rentals right now, you guys. Shocking. It's absolutely shocking. But not only that, Congress is working on new laws to curb institutional investment. So depending on if those laws pass, depending on if we have a rental crisis or not, that's when we'll really know what's going to happen to new builders. But I suspect that we're going to still get deals of our lifetimes from new builders. But remember, get a home inspection because of the quality of material. Now, in conclusion, I guess if we add the word bold in front of forecast, it means that we can completely disregard the data trends, quantitative tightening, massive equity surges, unaffordability, credit card debt exploding, the car debt market collapse, crypto collapse, and things like that in order for us to create an imaginary narrative. So isn't that interesting? Maybe we should just put bold in front of things. But the reality is that we must make up our own minds. And I really hope that you guys continue to see how important that is, because I clearly see that there is almost no one that you can trust or lean on in the real estate industry to give you guys clean and unbiased information. It's actually super sad. So in other words, you guys, make up your own minds. Now, other than that, guys, I really hope you guys got some new value, insights, and perspective from today's video. And if you're out there investing in real estate, you know I wish you luck, and I hope you win.